Welcome back to the Skillabration Podcast. We are in Season 2, Episode 2. In Episode 1 of Season 2, we talked about what money is. Now we're continuing on with that topic, discussing how money is a form of expression and how central banking currently affects us. So let's get right into it.
Welcome to the Skillabration Podcast, where it's career day every day. Your host, Nikki Lubing, is the owner of Skillabration, an online foreign language school for K-12 homeschool students. Nikki's experience learning Spanish as a second language led her to building a variety of skills that set her up for life, from soft skills to financial literacy. It's her mission to provide those same skills to youth around the world through the Skillabration Podcast. We'll be interviewing guests from a variety of backgrounds and careers, ranging from teachers to business owners and blue-collar workers. We're excited to uncover their wisdom and experiences, whether it's mastering a new language, honing leadership skills, or learning the ins and outs of money. We're here to take your skills from zero to fuego. Let's go! Before we start episode 2 of season 2, on financial literacy, I wanted to share how in episode 1 I discussed that I envisioned parents sitting with their kids listening to this together. And for episode 2, I would say you may want to watch this episode first before you listen to it with your kids, because we do get into some I don't want to say heavy topics, but I would say some more serious discussions about money related to poverty and how the middle class is shrinking. So, being that it is a little bit more serious, you may want to only listen to this with age appropriate students, and that's up to you, whatever you feel that your child can handle and what you would feel comfortable discussing with them. So, the main topic of today's video is looking at how we use money as a form of expression. And what I mean by that is using money how you see fit and how money can be a form of freedom. And we talk about how central banking can hinder that form of expression when inflation happens. As the parent, even if you don't have your child watch this with you, at least you have some tools to discuss these topics with them. You can kind of cherry pick what you see fit to discuss with them. All right, let's get into it.
I'm going to be sharing the screen. If you're a visual person, head over to YouTube for the full presentation.
There's a companion guide available for teachers, parents, and students. If you want to grab this presentation and also have students take notes, I will share the link to that in the description.
In lesson 1, we answered the question, what is money? So we discussed how money is a unit of account. That just means how we decide the cost of goods and services. It's what we use to compare the value of things. Money is also what we use to purchase goods and services. And it's a store of value, which just means you can save money and use it later. And you can also invest money, which we'll be discussing in future episodes. So today we're going to be looking at money in our current economic environment and how that affects money in our own lives. Before we get started, I want you to take 30 to 60 seconds and write down all the ways you spend money. If you're listening in the car or if you're listening while you're doing something else, you don't have access to sit down and write these things down, you can just think about it for a few seconds and pause the episode. Now that you have thought about or written down all the ways that you spend money, now take another 30 to 60 seconds to write all the ways you would spend your money if you had more of it. What do your spending habits reveal about you? Money is a form of expression. So when we say that it's a form of expression, it shows what your values are. This comes from Seb Bunny's book, The Hidden Cost of Money. He says money is the ultimate form of expression. So what does that actually mean, money being a form of expression? Well, if you have your basic needs met, and you can spend extra money after paying your bills, feeding yourself, and so on, you can spend money on different things. For example, experiences. Maybe you're getting your coffee at Starbucks, or you go out for lunch or dinner, you travel, You spend money on adventure, your sports, entertainment. Maybe you're spending money on material goods, equipment, tools, technology, games. Those are different examples of material goods. On your education. So are you going to college? But after college, maybe you're doing other things, like you're paying a coach, like somebody to coach you for business purposes, or you're getting certifications. You might need a tutor. So those are all different ways you could spend your money. But then if you have a lot of extra money, you can invest it or you can donate to charity. You can, and sometimes, people donate to charity even if they don't have extra money because they might have debt, and we'll talk about that in a minute too, but they still want to give back to others. It's a way of showing what you value. And then, of course, there's using money for power, whether it's for political purposes or maybe even just for luxury purposes, for extravagance. Examples of that might be luxury goods, luxury brands. When people have a lot of extra money, let's say when people have millions or billions of dollars, they would then invest in businesses. So they're called venture capitalists. So there's all these different ways of spending money. And again, it's a way of expressing yourself and showing what you value. We discussed this in the first episode, which was how do people view money? Some might view it on the negative end of the spectrum, like money is the root of all evil. And then others might say it's a tool or it makes the world go round. But what's interesting is money is actually amoral because it's the ultimate form of expression. It's the way that people use money that reveals their values and their priorities about money. So typically when money limits us, that's when we tend to have more of a negative outlook towards it. The main problem we have today is that money is losing value due to chronic inflation. So this is incentivizing debt and punishing savers. And we'll talk more about what that means in a little bit. But essentially, when you have inflation, you want to spend your money more quickly because it loses its value each day. Therefore, when money is inflationary, we can't really tell what people are valuing because they're in a state of survival. They're like, we gotta spend this money as quickly as we can because otherwise it's losing its value. And when we just put it in the bank, we're not getting interest on it like we used to. Think of Maslow's hierarchy of needs. Abraham Maslow, he was a psychologist, doctor of psychology. He went to the University of Wisconsin, and he has this theory. Typically, it's viewed in a pyramid, but it's about self-actualization. At your most basic level, you have your physiological needs, like you can breathe, you have food, you have water, you have shelter, your clothes, your sleep. When you have all those needs met, then you can kind of go up to that next level when you have your health, employment, maybe you have a home, your own property, family, social ability. Those types of needs are met. The next step would be love and belonging, friendship, family, sense of connection, having solid relationships. And then after that, you would be self-esteem. You're confident, you have dignity, achievement, respect of others. You have a need to be a unique individual. And then comes self-actualization. So your morality, creativity, spontaneity, acceptance, experience, purpose, meaning, and your inner potential. You're striving towards more in life beyond just those basic needs and more. So you're able to work towards bigger goals in life because you have all those other needs met. How does this relate back to money? Well, if you're in a state of survival, it's a little bit difficult to meet those other needs. What is life supposed to look like? If you envision your future, let's just say the classic American dream is get your own home and you start your own family and then you retire at a young enough age where you can still enjoy yourself, maybe travel, play some golf, go on adventures with your spouse. So obviously this is the quote ideal, but it's more to just give you a picture of the basic steps in life. Let's look at money as a form of expression when you're in these different modes. So you could be homeless, but you could also be starving. When you are in survival mode, that's like those are the most stressful places to be. And then you have poverty. So if you're in poverty, you might have some form of shelter, but you really it's worse than living day to day. It's worse than living paycheck to paycheck because it's very difficult. Maybe sometimes you can't even pay your bills. So that is definitely a survival mode. But even in the lower middle class and now in the middle class, you can still be in somewhat of a survival mode because you might have a lot of debt, and in that sense, you're never really feeling financially free because you're living paycheck to paycheck. Maybe you can go out and get a coffee. Maybe you can get some dinner or lunch sometimes and have some of those experiences going out with friends and things like that. But typically, you're not feeling like you're financially free. You want to ask that question, can you use money as a form of expression when you're living paycheck to paycheck? Or when you're just getting by, versus if you're upper middle class, if you're wealthy, or you're extremely rich, maybe you can, in those situations, like if you're living well, you can go shopping, you can buy certain things and you feel okay, like you're spending some extra money and you don't feel like you're going to go into debt, or you're not going to go into debt when you spend a few $100s. Or you can take a vacation and not feel like you're going into debt. In that sense, can you use money as a form of expression at that level? In a black and white sense, more money means more expression. Less money means less ability to express yourself. Money in that sense is freedom because you have the freedom to do and live as you please. Does our current system foster money as a form of expression? If you look at certain statistics, like this specific chart that I'm showing a chart right now. It's showing how the middle class is shrinking and the upper income has gone up, whereas the lower income has gone, there's more people in the lower income bracket and more people in the middle income bracket compared to the upper income. So we're seeing more separation between upper income, middle, and lower. It's either now people are in more in the upper or more in the lower. So what could be causing the middle class to shrink? It's being caused by inflation and wages being stagnant or the same. Incomes rose the most for the upper income households. So from 1970 to 2020, it rose 69%, whereas the middle income bracket only rose 50% from 1970 to 2020, and then the lower income amount only rose 45%. So in 1970, the lower income was 20,604, and then by 2020, it's only 29,963. That's barely anything for that amount of years. 1970 for the middle income, it's 59,934 versus in 2020 it's 90,131, and this is for a household, remember, not like an individual. And then if you look at the big jump for upper income, in 1970 the upper income household made $130,008, and then in 2020 it's $219,572. I'm going to be sharing all the resources if you want to go and look at these yourself, which I highly recommend that you do. It's always good to check people's research and look for yourself, make your own opinions, make your own conclusions after looking at things, because we all have our own biases, we all have our own perspectives. So always check people's research. And things you want to look at too when you're researching, look at the dates, look at how they did the statistics, because even statistics can be skewed to look a certain way. I can't emphasize enough to always double check research. So what is inflation? Inflation is the price of goods and services increasing over time. This can affect all industries like housing, food, medical care, utilities, products, and services, because when things are getting more expensive, it affects everything that businesses have to pay for with their expenses. So they have to increase what they charge. So it's kind of like a domino effect. When one thing gets increased, then the next thing, then the next, then the next. Investopedia says inflation can be thought of as the devaluation of money. So the value is getting less and less. It can be a concern because it makes money saved in the present less valuable in the future. Inflation erodes both purchasing power and the value of investments. So purchasing power is your ability to purchase something. Let's say if you want to buy something that's, let's just make it simple, like $10, but with inflation, if you have money in the bank, if you have $10 in the bank, eventually that thing becomes more expensive. So you don't have the purchasing power to buy that, what you used to be able to buy. Another example, if an investor earned 5% from investments in stocks and bonds, but the inflation rate was 3%, the investor only actually earned 2% in real terms. Wages are also an issue. Right now, according to economists, wages are now outpacing inflation, but is that really affected in people's lives? There's 3 different articles that talk about this. One article says that inflation hasn't fully recovered yet. Will it ever? Another couple articles talk about how prices stack up against growing pay. Wage growth is beating price growth now for 15 months in a row. But I thought that the article that talked about will it ever change? I'm just going to show you guys this article for a second. It says, study, Americans' pay hasn't fully recovered from inflation. Will it ever? And I'm just going to scroll down to this section where they have an example. It's by a section just referencing a citizen. So it says Robert Santee, a psychotherapist based in Connecticut, has taken on 20 extra clients in the 4 years since the pandemic. He says the decision was equal parts personal necessity and societal urgency. For starters, every corner of Santee's budget has grown more expensive. Car insurance for his family of 5 is costing him $10,000 a year. His monthly electric bills often range between $600 to $800. His cell phone bill has jumped by $40 a month, and even his grocery costs can easily reach $1,000 a week. He's taken on longer hours simply to replace some of his lost income. It's nickel and dime, and everyone wants a piece of the pie, he says. My pie keeps getting smaller and smaller and smaller. But whether it's lingering stress from the pandemic or financial anxieties surrounding inflation and recession fears, Santee says he's been in no need for clientele over the past 4 years either. He often takes calls from patients after hours and goes into his office on weekends to catch up on paperwork. He estimates that he gets about 4 cold calls a week from new inquiring clients, whom he has to turn away because he doesn't have enough room for them in his schedule. People are highly stressed, highly anxious, struggling financially. That leads to family squabbles, relationship issues, he says. You get the cable company, the electric company, the cell phone company, your mortgage goes up, your taxes go up. Any one thing might be manageable, but when it's death by 1,000 needles, that just wears on people over time. So think about what we talked about when being in survival mode. If you can't really tell when people are in that much stress, when they're experiencing that much stress, it's hard to tell what their values truly are because they're not able to spend money in a free way where they're able to freely express themselves financially. Contributing to his rising expenditures, his 2 youngest children are in college, while his oldest daughter is living at home on an extended job hunt after graduating 2 years ago. Him and his wife are now earning nearly $300,000 a year as a household, but they feel like they had an easier time getting by when they were in their early 20s, earning just $22,000 a year. Still feeling surprised by bills or unexpected expenses, he's had to temporarily halt his retirement contributions. I'm certainly in better shape financially than I've ever been in my life, but I'm not where I thought I was going to be or where I think I should be, Santee says. It'll get better, but I don't know if it'll get as good as it was. I realized everything goes up and up and up, but did it have to go up so much, so quickly, when I didn't have time to adjust? It just felt like it just happened overnight. Then it says, Americans look at inflation differently than economists. Analysts track annual rates of change in inflation to determine whether the U.S. economy is overheating, while the typical American consumer focuses on how much the items they see every day have risen in cost. Just 6% of the nearly 400 items in the Bureau of Labor Statistic tracks are cheaper today than before the pandemic. A bank rate analysis of inflation data shows key essentials that consumers regularly buy, like gasoline, groceries, utilities, rent, and more, have risen at a faster rate than overall inflation. Car insurance, meanwhile, is up almost 50% since February 2020. Inflation can have a profound effect on consumer psychology. Nearly half of adults, 47%, say money has a negative impact on their mental health at least occasionally. Bankrate's Money and Mental Health Survey, May 2024, found almost 2/3 of them, 65%, cited rising prices as a reason. It will require that workers continue to enjoy some restoration of buying power through real wage gains, Hamrick says, referring to when Americans could start to feel better. To the extent we see falling prices for goods within a fairly normal, not recessionary economic environment, that would be helpful. You can see how that article discussed a lot of what we discussed in terms of Maslow's hierarchy of needs and using money as a form of expression and the stress that it can put on you when you don't have purchasing power. Let's look a little bit more at how our current economic system is hindering us. Millennials are those born between 1981 and 96. I'm a millennial, born in 1983. They make up just 4% of the current housing market, even though they've reached their prime home buying age. Their parents, the baby boomers, made up 35% of the housing market when they were in the same stage of life. So look at how different that is. In 1970, Americans with an average wage could buy a new car for 45% of their income. Now the ratio is 106% more. These are statistics from Seb Bunny's book, The Hidden Cost of Money. So again, when we're thinking about envisioning your future, you want to consider, and this is something we're going to go over in future podcast episodes, is how to make wise decisions, not only financially, but also for your career. So you want to have the skills that you need to get into a career that's going to allow you to live in a way where you can express yourself financially, where you can feel financially free, so that you can live that ideal future by choice, not feeling stuck due to financial strain. So what's causing all of this inflation? This is a quote from Ludwig von Mises. He says, the most important thing to remember is that inflation is not an act of God, that inflation is not a catastrophe of the elements or a disease that comes like the plague. Inflation is a policy. We're going to talk a little bit about economists and their theories and the economic theory that's in play today and what policy we're using that's a culprit of this inflation. Ludwig is what you call an Austrian economist, and we're going to talk about that in a future episode too. We'll discuss the difference between Austrian economics versus Keynesian economics, and we'll talk about other economic theories too, because it's not just those two. It often comes down to just those two, people kind of talking about the arguments between those two, but there's more economic theories than those two. So let's learn about inflation and doing good research, because when you're researching something, you want to make sure you're using your critical thinking skills, asking questions, digging deeper, not just taking the first answer that Google gives you. And you can use other resources besides Google. This is where we go the most. Remember as well, you can use other tools, physical books, for example, going to the library, researching that way as well. And also when you're in college, universities have other research tools that you can use that aren't open to the public. So if you're ever working on a research paper, that's something to consider too. Okay, so central banking and the Federal Reserve. Nearly every country around the world, and certainly every developed industrial nation, has a central bank. Most serve one or more of the following functions: acting as a bank for bankers, issuing a common currency, clearing payments, regulating banks, and acting as a lender of last resort for banks in financial trouble. The one thing they all do is serve as banker to their own governments. And this is from the Minneapolis Federal Reserve. There is the central bank with the branch in DC, and there's 12 Federal Reserve banks in bigger cities. Minneapolis is one of them. So like Chicago, New York, St. Louis, there are 12 of them. So before we got to the Federal Reserve Bank that we have today, there were several iterations of central banks in the US. Due to the founding fathers being against central banking, there were fierce opponents that fought central banking throughout history. Also, it's unconstitutional for state governments to issue their own currency. So, iterations of central banking. There was first the Continental Notes in 1775 that ran through 1790. These funded the Revolutionary War. Notes were supposed to be used on demand. Basically, you got the money right away from those notes. Congress used more than they said they would, which caused inflation, and then people were like, we don't trust these notes. Like, there's no actual money behind them. So it's like the bank would think of a literal piece of paper, a note that would say, this is how much money you would have. Then people were against it, and so that failed. The first Bank of the United States was then created in 1791, and that lasted until 1811. This funded the war debt, and it created some financial stability. It served as a commercial bank as well, which isn't something that the central bank does today, though. After the debt was paid off, people argued the bank was unconstitutional and fought against it. Then the second bank wasn't created until 1816. So that last one was until 1811. So it took a few years until they created a second one. And this funded the War of 1812. It regulated state banks. It functioned similarly to the first bank, but it was not well managed. It almost failed within a year and a half. And then a man named Langdon Cheves became president in 1819. When Andrew Jackson became president of the United States, he fought against the bank and crippled its resources. So then it ended. Then there were free banks from 1837 to 1863. These were not regulated other than depositing bonds with state auditors. Hundreds of banks opened because they were not regulated. And the Suffolk Bank in New England took on some central banking roles, such as clearing payments, exchanging notes, and disciplining banks that overissued notes. Then there were national banks from 1863 to 1913. The Civil War led to the need for a central bank. After learning from the problems of the Second Bank of the United States, they modeled the national banks after the free banking system. So, banks chose between a national charter and a state charter. The national charter banks had to issue government-printed bills for their notes, and the notes had to be backed by federal bonds, which helped fund the war effort. Now, state banks, they used their own currency, but they were taxed out of existence by the National Banking Act. So in 1865, a national currency was established for the first time. Now, what happened down the road here is that there were these panics every decade. There was the panic of 1873, 1893, and 1907. So customers would panic when their bank didn't have enough funds to cover their withdrawals. So everyone would run to the bank and try to get their money out at the same time, and then the banks would collapse. And then in 1893, the panic led to the worst depression the US ever had. JP Morgan bailed out the banks at that time, but then there was another panic that happened in 1907, and that's when the government was like, okay, we need to create a central bank. And between 1907 and 1912, they prepared to create the central bank. So that's, they took quite a bit of time to really figure out what they wanted the central bank to look like. There was the Aldrich Vreeland Act of 1908, which allowed emergency currency to be issued during crises. The act created the National Monetary Commission to figure out a long-term solution to the nation's banking and financial problems. And Woodrow Wilson was elected president in 1912. He approved the Federal Reserve Act of 1913 that was created by Carter Glass and H. Parker Willis. The law was considered a compromise between the interests of private banks and the people who disagreed with centralized banking. So the Federal Reserve was created in 1913, and this is what we still have today, although what they do now is different than what they did back then. So what private banks used to handle, the Federal Reserve now handles. They handle commercial lending. That's, again, a little different than what we do today. Profits in excess of cost handed to the U.S. Treasury, and then authority over the nation's payments system. Decentralized into district banks that operate independently with an oversight board in DC. So that's one of the things that the Federal Reserve did. Each district bank issued its own money backed by gold. The gold standard was abandoned in 1933 because it limited the bank's ability to supply money. And today, the Federal Reserve is known for its monetary policy, which wasn't one of its original roles. Its main role was to prevent those bank panics. The federal government took more control of the Fed. That's what you'll hear it called today, just simply the Fed, during the Great Depression and World War II. The Fed regularly reports to Congress to answer questions. In the 1970s and early 80s, the nation experienced stagflation, which is when inflation and unemployment were very, very high. Congress then had the Fed issue monetary policy. They raised interest rates, which increased inflation and unemployment, but eventually it stabilized. And then the Fed has offered lending programs during the Great Recession and COVID-19. I did some research, and just by asking what is the U.S. economic system, the economic system is different than the Federal Reserve's monetary policy. The monetary policy of the Federal Reserve is like a tool or a strategy that they use under our economic system. So our economic system is a mixed economy. It's part capitalist, part socialist, and we'll talk about the difference between those two in episode 4, I believe. Episode 3 is going to be Austrian versus Keynesian economics, and then episode 4 is capitalism versus socialism. I also asked Google if our current system is inherently inflationary, and the answer from Google was no. We are living in a Keynesian era. John Maynard Keynes was an economist. So I asked if Keynesian economics is inherently inflationary. The answer was also no. Part of Keynes's principles include stimulating the economy with a policy called quantitative easing, which is basically making money out of thin air. We're going to look at some quotes to discuss what it is. When I Googled the connection between money printing and inflation, then I got a different answer. Let's go back to quantitative easing. What is quantitative easing? It is when the economy hits a rough patch, central banks often come to the rescue with emergency monetary stimulus known as quantitative easing in order to increase liquidity, basically money. So you have your assets, your liquid assets that you can use, and help spur economic growth. The central bank buys trillions of dollars worth of long-term securities, mainly government bonds, although it can also purchase corporate bonds, municipal bonds, mortgage-backed securities, and even stocks. By purchasing these securities, the central bank drives interest rates lower, which fosters more lending among the banks, who in turn make it easier for their consumers to take out a mortgage or a business loan, etc. So the central bank is giving money to the other banks for the banks to then have the ability to offer loans and mortgages to the public, to us, the consumers. It sounds very complicated, and I would say it is pretty complicated. It's not something that's just cut and dry. There's a lot of different aspects to it. Some of the criticisms, it is also called QE, quantitative easing is just abbreviated as QE. Some criticisms of QE include it might cause inflation. It can have a negative impact on pension funds. So if somebody has a pension, like teachers have a pension, police officers have a pension, those are just some examples. But so it could have a negative impact. Pensions are used when you retire. You get money that every time you get a paycheck, some of your money goes to the pension. So the money that you earned, let's say you earn $1,000 and 100 of it goes to your pension every paycheck. Then when you retire, you're supposed to get that money. So if it has a negative impact on pension funds, that's a little bit scary for those people who had been giving their hard-earned money to the pension. It can increase income and wealth inequality. And we just saw how the middle class is shrinking. So is that a result of this QE? It can have a negative impact on the climate, which I thought that was kind of interesting. I didn't really understand that at first, but then when you think about it, if you think of something called fast fashion, that is when like stores like H&M, they create a ton of clothes, and those clothes are just created in factories really quickly, and has a negative impact on the climate. But they're cheaper. So if our money doesn't go as far, we have less money because of the inflation. We don't have as much, like $100 doesn't go as far as it used to. You used to be able to get a lot more with $100 compared to what you can today. So you would go shopping at a place like H&M or a Walmart or wherever that creates a lot of clothes, mass produces those clothes for a cheap amount. So if more people have to do that kind of shopping, in turn, that's not good for the climate. So that's just one example of why it would have a negative impact on the climate. Okay, so lesson from my research, and you're gonna see exactly what I typed in Google. I took screenshots. Don't trust the first answer that Google gives you, because here's what I did. You want to keep digging and ask different types of questions to try to get to your answers. So the first thing I said, the connection between money printing and inflation. Does printing money cause inflation? And the answer said yes. Printing money by increasing the money supply causes inflationary pressure as more money is circulating. And then it says it increases in production costs associated with raw materials or labor or market disruptors like those caused by the COVID-19 pandemic. I also said, do you always print money in Keynesian economics? No, printing money is not always the solution in Keynesian economics. Keynesian economists use a variety of policy tools to stimulate the economy, including deficit spending, tax increases, and monetary policy. Liquidity trap. In a liquidity trap, increasing the money supply does not lower interest rates, which means it does not boost employment and output. Government knowledge. Keynesians believe that government doesn't have enough information to successfully fine-tune the economy. Risks. Printing money can cause inflation. Other risks include depriving the population of money by taxing it or depriving firms of capital by borrowing money. Is quantitative easing printing money? Critics have argued that quantitative easing is effectively a form of money printing and point to examples in history. So these are just a couple things that I looked up. And then this is an article that I got that talked about QE. When I first talked about making sure you you type in Google, you type different things in to get your answers, that's because you have to dig deeper. Like when I first just said, what is the US economy? What is the US economic system? And it talked about the mixed economy. You have to ask things in a different way to kind of get to the inflation and the policy, because you have to understand that it's monetary policy. It's not the economic system. Those are two different things. So if you don't even know that, you have to be able to keep researching and researching and researching until you get to understand that next level. And when I asked if our current system is inherently inflationary, originally it just said no. But then when you learn about quantitative easing, that does cause inflation. And they still don't really say it causes it 100%. But when you're living it, you're like, okay, well then what else would be causing it? So let's go back to this other slide. Is QE printing money? To the extent that it involves the central bank creating bank reserves to acquire assets, QE can be called printing money, but it is not very informative to do so. Bank reserves are the most basic form of central bank money, and the central bank can and does create them electronically out of thin air. That does sound at least like the electronic printing of money, but the QE kind of money printing is quite different from the sense in which the term is usually used. Either Milton Friedman's helicopter money or wanton deficit financing by the central bank. So how is QE not the same as helicopter money? So Milton Friedman's idea of helicopter money was the government could always trigger inflation, strictly a one-off rise in the price level by dropping bank notes from helicopters. Remember what von Mises said, that inflation is a policy, and that is literally what this sentence just said. Government could always trigger inflation. Friedman's notion was that this exogenous increase in the money supply would be absorbed by rising prices, as more money than existed before would be chasing the same amount of goods and services. This is different from QE and is better viewed as government tax cut permanently financed by the central bank. Given that the government couldn't realistically distribute cash by helicopter, and in most banking systems, the cash would be a liability to the central bank, not of the government, the closest operational arrangement for implementing a helicopter money policy would be for the government to give all households a check for, say, $10,000. Remember, we got COVID money like that. They just gave us a check. And finance an associated increase in the government deficit by issuing non-marketable zero-coupon perpetuities to the central bank. Although the balance sheet mechanics are similar, there are a couple differences between this form of helicopter money and QE. One is that ostensibly, at least, central banks under QE, independently of fiscal policy, taking the government's fiscal policy stance as given. Helicopter money is a joint operation of the monetary and fiscal authorities. In fact, is probably best viewed as monetary operation of the consolidated government. So that kind of explains just a little bit of difference between Milton Friedman and Keynes. And right now we're using QE. So we're using what Keynes' theory is. And we're going to talk more about that in the next episode. So couldn't fit it all in today. This is already a long episode. So what happens in layman's terms with quantitative easing? This is a monetary policy where central banks buy securities to increase the money supply and reduce interest rates. This can have several effects, including lower interest rates. QE can reduce long-term interest rates, which can make it easier for consumers and businesses to borrow money. Increase spending. When it's easier to get loans, people and businesses are more likely to spend, which can increase demand for goods and services. Increased economic activity. QE can stimulate economic activity, which can lead to job creation and economic vitality. Impact on the stock market. And we're going to talk about investing. So remember this for when we do our investing lesson. Impact on the stock market. Investors may buy shares of companies they expect to benefit from increased spending and consumption. impact on the bond market. QE can affect the bond market. Impact on savings and pensions. QE can have an adverse impact on pension funds. We talked about that because low government bond interest rates can cause the real value of savings to decline, which again, we discussed how savings is affected. Your money doesn't have the same purchasing power as before. Impact on mortgage rates. QE can directly impact mortgage rates. For example, in 2020, the Fed's QE efforts helped mortgage rates fall below 3%. There's also quantitative tightening, that is reducing the amount of money in the economy, which was done between 2017 to 2019 and 2022 to 2024. We have QE and QT due to central banking. So this is part of their monetary policy. To summarize, money is used to determine value. This is where we started today. It's to exchange goods and services, and it's used as a store of value to save for the future. Money is also the ultimate form of expression. When we have money to spend, it reveals information about us and provides us with more opportunity. In our current economic system, we are losing purchasing power with the central banking that we have. So with the central banking policies that we have. So you might feel like, oh my gosh, what do we do now? You might feel like a little bit of doom, but is it just that we need more money? Well, here's a theory we can go with. This is a little more empowering. So look at this as empowering rather than demoralizing or putting you kind of in a low mood. So it's empowering because you have knowledge and you have information. So you want to use as much knowledge and information plus skills and tools and wisdom to get to success. It's all those things combined. And that's why we're going to look at things like what to do with your personal finance. What kind of skills do you need in the real world to combat some of these issues that our current economic system is imparting on us? So when you get out into the real world, you have those skills and you're setting yourself up for success with the knowledge that you have today by getting this now in your youth. Then you're going to be prepared to make smarter decisions and wiser choices when you decide what kind of job you're going to do. You're going to look at, okay, how much can I realistically make per year? And from there, when you choose a job that gives you the amount of money that you need in the world, then, and you're not living on like wishful thinking, right? Because wishful thinking or magical thinking it's not going to be the wisest choice. So that's where that wisdom comes in, and you want to utilize that to your advantage and make those choices to set you up for success. And don't forget, you want to go back to envisioning your future. If you want that independence in your adulthood, if you want to have that purchasing power to own a home, start a family, whatever it is you want, however you want to express yourself financially, you have to make those knowledgeable, well-informed, wise decisions to get you there. We finished our portion of understanding money. We now know what money is. We understand money as a form of expression and how it relates to the central banking of today. And next up, we're going to look at basic economics. Once we get through the next section, it's going to be a piece of cake from here, because this is the first two parts, basically the first 4 episodes of this podcast. These are going to be the most difficult. So getting through the most difficult first is great, because then it's smooth sailing from there on out. So thank you for sticking with me if you stayed until the end. After we get through the basic economics, we're going to be discussing finance, budgeting, investing, and entrepreneurship. Those are some of the skills that you're going to take with you to be successful. I also have a full list of resources in this presentation. I'll share them in the show notes and the description as well. This curriculum is also available in my store, in the Skillabration store. So that'll be linked as well if you want to get the access to this. I create with every presentation This is basically your lecture. And then from there, you have the presentation and you have notes that you can utilize for if you're a teacher, if you're a homeschool parent, and you want to sit side by side with a student and show them this and work through it all together and do it as a lesson together. There's a resources for the students. It's a companion guide to go with the presentation, and that'll be linked in the description and the show notes as well. Thank you for sticking with me until the end. I look forward to discussing Austrian and Keynesian economics in episode 3. See you in the next episode.